really, really, really want to pay attention to this part, because this is where it's at when it comes to real estate. You see, when it comes to financing, okay, when it comes to financing, there are only two types. There are only two types, two general categories. When you look at getting access to capital for a deal, you either have a traditional approach to getting access to capital, or you have a creative approach. A creative approach. So traditional or creative. Only two. Now, when you're looking at traditional, there's a lot of different subcategories here, right? In fact, many people would argue that there's possibly more, but in my experience, there are really only 14 types of traditional financing that exist for real estate investing. 14 different types. You have a traditional mortgage loan, right? That traditional mortgage loan is an option for you, right? That's you're going to a bank, you're going to get a relationship with that bank to secure the acquisition of real estate. Remember, real estate is just dirt or dirt and an improvement, right? You also have something called a home equity loan. Now, the concept of a HELOC is not limited to a home, right? It's simply a framework. It is loaning based on equity of something you already own, right? A mortgage is typically oriented for acquisition. A HELOC is typically oriented for getting access to equity you already own, right? However, in the past 15, 16 years, HELOCs for acquisition have actually become pretty popular. In fact, we had a individual come into the studio and did a guest expert lecture and was talking with our community about this concept of a home equity line of credit that can actually be used in the first position. In the first position. See, most people think of the home equity line as, again, just getting cash out of an existing deal and you pay it off as it goes. But the big difference between a home equity line and a traditional mortgage is how the interest gets calculated. Right? So a traditional mortgage is amortized, which means in the beginning of the loan period, the majority of your payment is interest. The banks love that arrangement because anyone know the average hold period for a property in the United States when you buy it? It's about 8 years, 7 to 8 years. And the vast majority of the interest payments then, or the payments in general over those 8 years are interest. And after that period of time, many people sell the property. What do they do when they sell it? What do they do with that? They pay off the loan and then do what? Buy another house and get what? Another mortgage, start the whole ball game all over again. The banks are big because they take your money and they make money from it. A lot of it. Because they love that arrangement. And that's why the banks do all of this arrangement to get you organized towards refinancing your loans, right? They love that process because it starts the ball game all over from scratch. A HELOC is different. You see, a HELOC is a revolving credit type of relationship, more similar to a credit card. But when you put a HELOC in first position, what you are doing is you are essentially making the HELOC your bank account. Whereas normally you would have your own checking account where you deposit your monthly income into, then you use that monthly income to write checks for the bills that you have in your life, right? Paying your mortgage, paying for groceries, buying fuel, whatever it may be. But a HELOC in first position is different because what that does is that essentially acts as your bank account. And you deposit all of your income into that bank account every pay period. If you're an S corporation, you're taking a reasonable salary. Every time you take a reasonable salary, if you are taking a draw, every time you take a draw, it gets deposited into the HELOC, and that just lowers the balance of the HELOC. When you lower the balance of the HELOC, what happens to the interest? Goes down, right? Because you pay less interest because the balance is lower. And then when you need to pay your bills, the ideal way of doing that is to use a credit card pay your bills, and then once a month you use the HELOC to pay the credit card. And what that does is it erodes the time frame that you have to pay that back, because you essentially shorten that debt cycle. You reduce the amount of capital that goes to the bank in the form of interest, and you maximize the amount of capital that goes towards actual principal payment, which reduces your actual interest cost. So if you put a HELOC, a side-by-side comparison of a HELOC to a traditional mortgage, same interest rate, if you use that and you pay it the same way you normally would have paid it, same dollar amounts, the only difference is you deposit all of your income, you can shave years, if not tens plus years off of your mortgage. So a 30-year mortgage could become a 14-year mortgage simply by doing that. Shave 12, 15, 17 years off your mortgage, depending on how much capital you put in. Yes?
So why is that beneficial to the bank?
It's not beneficial to the bank. That's why they don't advertise it. Very, very rarely do you ever, in fact, I think I've seen one advertisement from a bank for a HELOC in first position. One in 26 years. I think I've seen one ad for it because it's not very advantageous. But they exist because they do solve a need, right? They solve a need. They solve a need for financing for certain individuals. So that's a product. So the bank is interested in making money any way it can. They would much rather you have a traditional mortgage because they make way more money on that. And I would say that many individuals don't actually act prudently when it comes to debt. So even those who do get it, they may not operate it correctly. They may not operate it well. And for the members of the community that have access to our community, again, you would go into that training, which was it's not capital stacking. Where is it? Yep, here, the HELOC strategy. So inside of this environment, this course, it's about almost 2 hours long, literally walks you through the step-by-step of how to put a HELOC in first position. It's an amazing concept, right? Yep.
And can you do that? Let's say you have your existing home.
Yes.
You can do that now.
Yes.
Without having to trigger any kind of due on sale.
So you can actually have the HELOC pay off your existing mortgage. Now here's the thing. A lot of people say, well, Edward, interest rates are ridiculous right now. Why would I ever do that? Because it's not an apples to apples comparison. You can have a HELOC at 9% and it's better than a 4% traditional mortgage because of math. You can run the numbers. In fact, during this training, that's one of the things that was talked about, right? This is just not stuff that's taught in school, right? I'm teaching it here to you because this is really what true financial literacy is all about. When you learn the rules of the game, you can start playing the game to win. This is a rule to the game. Most are not going to teach this stuff to you. This is part of our community. We brought a guest expert in who this is all they do. They focus on helping individuals get access to capital in the form of a HELOC in first position. They have a whole program by which they do that. They walk you through it step by step. They came in and did a whole training on it. So if you have not yet jumped into this or unlocked this, if you're in the premium environment, if you have not unlocked this yet, this is definitely something you want to consider doing, especially if real estate is in the ballpark for you. With that being said, we have now, I don't know where the slides went. Somewhere. Oh, Google Slides. There we go. Excellent. So we have this environment now where traditional financing is in existence, right? We talked about these 14 ways, but we're not through the 14. We only did 2. We did traditional and we did HELOC, right? We also have the FHA loan. The FHA loan. This is a loan type that is government backed. So that means anytime the government gets involved in securitizing a loan or guaranteeing a loan, there are requirements. FHA loans are often available for individuals who have a little bit more of a challenged credit situation. An FHA loan requires you to live in the property. So this is ideal for like multifamily properties. Like if you have a multifamily opportunity, you can live in one unit and rent out the others. This is a beautiful loan program for it because FHA loans require a lower down payment. If it's your first property, if it's your first FHA loan, it could be a down payment as low as 3%. More traditionally, it's about 5% for most borrowers. Everyone advertises the cheapest or the lowest amount, but the reality is when you go through the underwriting process, 5% tends to be the area that people fall into. You also have this thing called a conforming loan. So a conforming loan is a loan that a bank will issue that will adhere to standards that are set by the Fair Housing Administration. So there's a whole set of criteria that the loan has to meet with regard to the credit worthiness of the underlying borrower, the down payment amounts, the amounts that are being financed, meaning there's limits on how much you can potentially borrow for a particular property. Right now, that limit is somewhere in the high 600,000s, right? So you're able to borrow in a conforming way for most properties as long as the amount that you're borrowing is less than that $700,000 figure. Again, these things change though year to year. The concept is what I want you to learn. The framework is what I want you to learn. Because as these little changes occur, you can learn those little changes. You can adapt to them. What I want you to really understand is the framework. How are you thinking about things? There's also a program called the 203K loan. 203K. This is a very specific type of loan that is oriented towards construction rehab, right? If you want to buy a property that is really not in good condition right now, you can use a 203K loan that will give you extra money to rehab the property, to fix it. Very similar criteria, creditworthiness, ability to service that debt. The 203K loan is for those properties that need rehab, right? Those properties that need rehab. Portfolio loans. A portfolio loan is something I also like a lot if you're trying to develop a relationship with a lender. Because a portfolio loan is a type of loan that the lender will hold on to. They're not going to package it up and sell it. It's not going to go to a third-party service provider. They're going to keep that loan. Many credit unions hold portfolio loans, right? So if you go to a credit union to get financing for a property, most of the time they're going to just hold on to that. They're not going to sell or package that loan to some third-party servicer. Why is that important? Because you can develop a relationship then with that lender, right? You develop a relationship. They can become used to who you are. They can become used to your financials, right? They learn about what you're doing. It requires a little bit less work down the road. All of the other loan types that we're going to talk about, other than portfolio, all of the other loan types are brand new every time you get a new loan. Like everything's brand new. Like you have to constantly offer them all the same information in its current form at that time. With portfolio loans, the relationship with the banker is one that's ongoing because they're going to hold on to your loan, they're going to service that loan, they're going to get to know you. I like portfolio loans for relationship building purposes when it comes to borrowing. There's also something called a VA loan. A VA loan is specifically for individuals who have served in the armed services. These are government-backed loans. These also offer lower down payments for the acquisition of the property, typically also allow for lower creditworthiness for applicants to get in. Again, those are government-backed loans, VA loans. There's another loan program that's called a USDA loan. USDA loan. These loans are for the acquisition of properties that are typically in non-urban areas, rural areas. Think homesteads, farmlands, suburbs of suburbs, right? These loans are very attractive, but there is a limitation. The limitation is that they're not always available, meaning they come in and out of availability in a given year. Like you may be able to get one today, but if you wait 2 weeks, the loan period may close and it may not be available in that area until next year. So there's limitations with regard to these loan programs, right? But it is a government-backed program backed through the USDA. When it comes to loan concepts, there's also something called a DSCR loan. DSCR. This stands for Debt Service Coverage Ratio. This type of loan, while it is a bit creative, is still traditional in nature because it is issued with the borrower being the property, not being you. You're the guarantor, right? The borrower is actually the property in a DCR because a DSCR, they're looking at what is the underlying profitability potential of that property. They're going to say, what is the rent roll of that property? What is its capable rent roll, right? By looking at comps. They're not even going to ask for your personal tax returns on a DSCR because even though you're the guarantor of the loan, they're not looking at you for anything other than credit worthiness. You have to have a reasonable credit score. When I say reasonable, it just has to, it can have a 5 in the front of it. It could be like a 580. You could still get a DSCR. 6 is preferred. 7 would be phenomenal, right? DSCR loans are still, though, more on the private side of the loan spectrum because each institution is going to have its own DSCR program. So if an institution, a bank, is going to participate in DSCR, they set their own standards. They don't have to adhere to any governmental requirements of this is the minimum, that's the maximum. Each institution will have its own DSCR program. There's also something called hard money lending. Hard money lending. This is still traditional, right? Why do I say it's traditional? Because this is pretty commonplace. These hard money loans happen all the time. They are a daily occurrence throughout the United States. A hard money loan is a short period loan, and it's typically transactional in nature, meaning it's designed to cover transactional costs, short-term borrowing needs, usually has a life of anywhere from 7 days, maybe even less, 7 days to 30 days. Meaning the money that's being borrowed is very short-term. It's usually not a long position loan. It's a short position loan. We're going to talk about how these play into some decision-making in a bit. But the concept is the hard money loan is typically very short-term in nature. It is happening in almost every circumstance from a private lender, right? A private lender. It's not an institution. It's an individual or a person who set up their own company to do this type of work. It is a private scenario. We also have what is called private money lending. Private money lending is a very similar concept, but longer term in nature. This could be 30 days to 3 months, right? Or even up to a year. But these scenarios are longer term than the hard money. Hard money is a very short term type of structure on most occasions. Private money tends to be a little bit longer than that, but it's way less than any other traditional loan. There's also the SBA 504 and the SBA 7A. These two loan programs are specific loan programs that are part of the Small Business Administration's loan guarantee programs. The 504 and the 7A. Both of those loans are able to be used to acquire real estate. The 504 tends to be used for large real estate acquisitions. When I say the word large, I usually mean more than $1 million, but that's not necessarily a requirement here. It just tends to be a larger acquisition that you're talking about, larger borrowing, and it caps out at $5 million. $5 million. The 7A tends to be for more, for smaller deals and tends to be oriented just towards residential acquisitions. The 504 could be either. The SBA 7A tends to be for residential only. And then we have cash. Because cash is an option, right? If you're looking to finance a deal, finance your own real estate activity, cash could be a method you use, right? Your own cash. Whether it's cash that's liquid or cash that's sourced from other assets that you may have, cash is cash, right? So that would be all 14, if you will, of the traditional types of access to capital for investing in real estate. We're going to talk about some of the nuance between them, but I just want to make sure that you have a big picture perspective. There's a lot of different ways to get access to traditional financing, traditional capital. Now, when it comes to acquiring real estate, we also have this opportunity of creative financing.
So there you have it. Hopefully you've taken significant nuggets of wisdom out of that vicarious opportunity to learn. You see, I know that many were not able to attend a session like that live, but hopefully you've been able to take something out of that experience so that you can start to put it into practice within your own life. But before you do that, I do have a question for you. How would your life be different? Imagine for a moment that you were part of a community that engaged in discussions just like this all of the time. Well, there is such a community. It's called the Uplevel Community. It's a community filled with business owners from all across the country that are all interested in the same thing that you are, taking your life and your businesses to the next level. Now, if you're interested in jumping in to explore what that community can look like and how you could potentially benefit from being part and parcel to this collaborative environment of business owners from all over the United States, all different industries and all different stages of their respective entrepreneurial journey, all you need to do is check out that link in the description below. I can't wait to see you on the inside. Bye for now.